Alright guys, I'm gonna try a different style of video today. Just walk you through the charts, give you guys a lot of deep dive info. I'm not gonna be drawing many trend lines and all that sort of thing. No complicated markups in this video, but just a whole lot of info. So if you want to take notes, you can go ahead and do that. Let's get started. We're looking at the XAU USD chart, by the way, on the 4-hour. I want to start off by saying that trading genuinely becomes a completely different game the moment you stop relying on drawings and signals and complicated markups and start understanding how price actually behaves. The truth is the market, it leaves clues everywhere, and once you start to see those clues, those obvious clues, it becomes much easier to become a profitable trader. So I'm going to walk you through a clean, professional approach to reading these charts without ever having to draw a single line. Obviously, Fibonacci's, trend lines, boxes, and zones, they all help. But this video is going to cover just, structure, volatility, price behavior. Because when I worked in the hedge fund, a lot of times people just, analyze charts this way. Because it forces you to react to what the market is genuinely showing you, what the most important thing in the market is showing you, what the price is showing you, and not what you wish it was showing in a way. So let's get into it. So once you remove all the clutter from your chart, you're left with, I'd say, the most pure form of information, right? The candles, volatility, rhythm, behavior, and if you learn to read these elements properly, then you're no longer guessing what's happening to price. You're interpreting. See, every market operates on a simple framework. Remember this: impulse, correction, continuation, or reversal. That's it. Every chart movement fits into one of these stages. Your job as a trader is to identify which stage the market is in and whether the behavior supports continuation or signals a shift. Let me clear this out of here. Yeah, so as I said, your job as a trader, what is this? Your job as a trader is to identify which stage the market is in and whether the behavior supports continuation or is signaling a shift. And this is exactly why clean charts matter, because they expose the market's true intention, right? They reveal whether the current structure supports strength, weakness, balance, imbalance, all that sort of thing. So, you never need a trend line to know whether a trend is intact or breaking down, because trends reveal themselves through consistency. When a market is trending strongly, as you guys see over here, it behaves in a certain way. It behaves predictably, as you guys see right here. Since the massive run-up that gold happened, it was very predictable, right? Impulse moves, like the impulsive moves, were dominant, and pullbacks were very controlled. When I say that, what do I mean? These massive green candles, these are impulsive moves, right? You can see that they were predictable. But when the pullbacks happened, when these red bars came in, when the bad days happened, when the drawdowns happened, they were controlled. They were small. They were not that big. They did not demolish all the progress that gold has made. So the market keeps producing structure that respects the previous movement. In a strong uptrend, again, like this gold one, like this massive uptrend that gold had, upward moves are super decisive, right? They show conviction, they show momentum. Pullbacks are smaller, as mentioned, and pullbacks are smaller than impulses, and they lack aggression, right? The green candles are aggressive, and these red ones over here, they're not very aggressive. They're always, eaten up by the green candles soon. This is the simplest sign of strength. Downtrends behave the same way, but in reverse. Downward moves, as you can see from the second peak of this double top, downward moves show strength, and upward pullbacks are soft, right? So massive red candles, a little bit of an uptrend, and then again just demolished. So what matters is the relationship between impulse and correction. If impulses shrink while corrections expand, the trend is weakening. If corrections get shallow and impulses stay strong, then the trend is healthy. Think of trends like a rhythm. Once you hear this rhythm and understand this rhythm, you no longer really need, lines or whatever boxes or zones to guide you. Now let's talk about volatility, because Volatility it can be considered the heartbeat of the market. It tells you whether a move is sustainable or fragile. And what I like to use for volatility, one of my favorite tools, and genuinely one of the only tools I use a lot of the time, is the Bollinger Bands. This red, blue, and green band. Because it's one of the simplest, easiest for beginners to understand, and most powerful tools for understanding volatility. Because they show you when the market is expanding or compressing. When the bands widen, the market is experiencing expansion. That means there's movement with force behind it. And when the bands narrow, as you guys see over here, volatility is contracting, meaning the market is preparing for a shift, a breakout, or a period of indecision. Over here, as you guys can see, when the bands contracted, we saw a breakout right after. Markets move in cycles. Expansion over here leads to contraction. And contraction leads to expansion. Your job is to recognize what cycle the market is in. This helps you understand whether to expect continuation or transition of whatever trend we're in right now. So let's talk more about these Bollinger Bands. In a healthy trend, price interacts with the bands in very, very specific ways. Strong bullish conditions appear when price consistently reaches or rides the upper band. As you guys can see over here, massive bullish run up for gold. We were constantly hugging or breaking through or touching the upper Bollinger Band, this red line. Yeah. This tells you that buyers are willing to push price aggressively into volatility expansion. When the market begins to weaken, the first thing that changes is the relationship between price and the band. Candles stop reaching the upper band, as you guys can see over here. After the massive run-up happened, and then these red candles stopped reaching the upper band consistently. The bodies also get smaller. The mid-band begins losing its role as dynamic support. You see, at first, the shift may seem subtle, but it does always show itself, because you see fewer aggressive pushes, more hesitation, less commitment. It's not about, one single candle. It's about the behavior becoming less decisive in general. This shift in character can be the earliest warning sign that the party is ending long before the reversal even becomes obvious, right? Let's talk about right now, one of the biggest misconceptions in trading is that you have to draw support and resistance in order to identify levels. That's not true. The truth is that levels are created by behavior, not by lines. You don't need to mark anything. It may help you, but you don't need to do it. You simply pay attention to where the market hesitates, pauses, rejects, or accelerates. You see, a level in trading or in a market can be considered like a memory. It's a place where buyers or sellers previously cared. It's a reaction, not just a drawing. When price repeatedly rejects in an area, it's meaningful. Let me give you guys an example. Price rejected right here at 437, let's say 4380, and again at 4380. This is very meaningful because after this happened twice, gold crashed down hard, reaching all the way to 4K. That's almost a $380 move. And on the other hand, when price accelerates through an area after hesitation, that's also meaningful. And when price consolidates, as we saw over here, and then breaks, that's also meaningful. You don't need to draw anything because your brain is far better at detecting patterns and clusters than a straight line could ever. You know what I mean? So let's talk about the structural story of a market. Because every chart you look at, it tells a story in chapters. The market doesn't just move randomly. We all know that, right? It transitions. And a typical sequence looks like this. Okay, so let's go through it. A buildup of pressure, as you've been seeing over here. A buildup of pressure, and then a breakout. A breakout starts to happen, and then the breakout accelerates. And then eventually, after acceleration, you get to exhaustion, right around here, and then a stall, exhaustion, and then a shift, and then a reversal comes, and that's when the correction happens, and that's what we've been seeing in gold since the all-time highs at 4.38. Once you start recognizing these chapters, the chart stops becoming, just a whole bunch of noise, and you can start to form a narrative. You begin to see the warning signs before they even matter to anyone else. So In a way, you become proactive instead of reactive, and that's very important. The most important concept as well is momentum shifts, because a market almost never reverses out of nowhere. First, it loses strength, and strength isn't just measured by price going up or down. It's measured by the quality of the movement, and a few things always appear before a reversal. Whether you be looking at gold or Bitcoin or the S&P or Nasdaq or stocks, a few things always happen before a reversal. Impulses weaken, candles lose body. Let me just zoom in for you guys. As I was saying, impulses weaken, candles lose body, wicks increase, volatility contracts, price struggles to reach the band extremes, and corrections deepen. These clues show up long before the actual turn, right? So this is why clean chart reading is so powerful. This is why you don't need to generally have 100 different indicators or whatever slapped onto your chart. You don't need indicators to tell you what's already happening. All right, so let me tell you guys about transitioning from trending to ranging. So a market doesn't just go from trending to reversing just like that, right? It passes through balance. And this balance, this is where traders get trapped. They misinterpret a slowdown as continuation when it's actually distribution. Or they mistake distribution for accumulation. The only way to understand this is to recognize the signs of balance. In balance, the price oscillates instead of expands, and volatility decreases, and candles overlap. As you guys saw right here, this is a perfect example. From over here to over here. Volatility is down, candles are overlapping, and neither side, not buyers or sellers, are dominating. And this phase is incredibly important because it defines whether the trend continues or reverses. And if you can read balance, your entries become cleaner, and your exits also become cleaner and smarter. So if you guys want, to have smarter exits as well, another thing that can help you a lot is understanding the behavior that defines different market phases. There's 4 major behaviors I want you guys to learn. Directional movement. This is when one side is clearly in control, whether it be buyers or sellers. Corrective movement. This is when the market is still trending, but at a slower pace. Pullbacks are still controlled, and candles show hesitation, but not yet rejection. The third one is balanced movement. In balanced movement, neither side has an advantage. Price compresses and volatility contracts, and behavior starts to become choppy. And then there's the reversal movement. This is when momentum flips and former support becomes resistance. I think that most traders genuinely know most of what I said here, but 99% of traders are not profitable, and they blow up their accounts, whether it be prop firm or live accounts. They all blow them up. And it has nothing to do with strategy or lack of knowledge. It's because they drown their charts in lines, and they rely on lagging tools, and they memorize patterns and candlestick patterns that they don't understand. They try to predict the market instead of truly interpreting what they're seeing in front of them. The deeper issue is that all this clutter that they put in their minds, it creates what's the right word for this? Maybe like false confidence. Traders think a chart with 20 drawings on them gives them clarity. It doesn't. It just hides the truth and creates illusions in their mind. Because once you trade a clean chart, you are forced to confront reality, right? You see when the market is strong, when it's weak, when it's balanced, when it's building pressure, when it's losing pressure. And that level of clarity is what keeps you out of bad trades and in good ones, hopefully, right? So listen, guys, genuinely, I want to end this off by saying clean chart reading is the foundation of real trading. Honestly, I was in a hedge fund, and I'm telling you guys this wholeheartedly. It's the difference between following random lines and actually understanding real market behavior. Once you see the structure and volatility and momentum clearly, you never go back to just cluttered charts again. If this helped you, if this quick little video helped you, subscribe, and I will be doing a whole lot more detailed breakdowns with some more indicators that I use, not a whole bunch, just a few more, just to, please some people who might understand more with those indicators, who want to learn more about how to use them. I'll be dropping that in later videos. Just wanted to get on here, give you guys a quick update. And yeah, so if you like this type of video, subscribe, and I'll see you guys in the next YouTube video.